Okay, let's talk about interest-only mortgages. Last couple of days, I've been breaking down the different types of mortgages in the U.S. We covered fixed-rate mortgages. We covered adjustable-rate mortgages, or ARMs. So if you're interested in those, check those on my channel. Today, we're going to talk about interest-only loans or interest-only mortgages. So what is that? Well, this is a type of mortgage. Usually, it's a shorter term length. Oftentimes, it'll be 6 months, 9 months, a year. Occasionally, you can find interest-only mortgages that are a couple years, but generally the term length is a lot shorter than these other types of mortgages, which could be amortized over 20, 30 years. Okay, these are short-term solutions, usually for new construction of properties. It could be for renovations and rehabs of properties, bridge financing. For example, if you're selling your home and you're buying a new home and the closing dates don't line up, you can get financing to purchase that new home while you wait for the other one to sell. So short-term solutions, and oftentimes the lender on an interest-only loan is going to charge quite a bit higher interest on that money, okay? And this is the realm of the private lenders. So these are like individuals that lend their money, private investors that lend money, private money lenders, also hard money loans. So there's lots of companies out there that do hard money loans, short-term interest-only loans, and they're looking more at new construction, fix and flips, that kind of stuff. And oftentimes they're looking less at the borrower's ability to pay the mortgage, and they're looking more at the property. They're concerned more with the loan value that they're lending at, what the ARV or after repair value is going to be on the project, if it's going to be a new construction or a fix and flip mortgage. Okay, so a lot of times because of this, there's might be a little bit more risk that this lender's placing on the project, because there's a lot more that can go wrong, and so they're going to charge a higher interest rate. So you're looking these days 10, 11, 12, maybe even up to 15, sometimes even up to 18%. Okay, and oftentimes these will be first mortgages, but sometimes they'll do interest only second mortgages as well. Okay, so how this works, instead of paying down the principal every month as you would with a longer term amortized mortgage, you're only paying the interest. Okay, you're not paying any of the principal down until the very end when your term is up. So if it's a 1-year mortgage, once that 1 year's up, typically now you owe that lender the entire amount back. Okay, so let's just say you borrow $50,000 to do a renovation on your property, and it's a 12% interest only loan. Okay, that means that you'd be paying interest only, which would be $500 a month. And then after that 1 year, you owe that 50 grand back to the lender. Okay, so that's the difference. Now, as a note investor, and that's what mainly this channel is about, is investing in notes and investing in real estate. There are definitely options to buy performing and non-performing interest-only loans and rehab loans. Okay, so those options are out there for you. The interest rate is definitely attractive. So if you're looking at buying notes where the interest rate is 12% and above, there's options there. But the downside is that there's quite a bit of risk if you don't know a lot about construction. Okay, so if it's a property that's under renovation or new construction and you're buying the note, well, you need to have really good boots on the ground. You need to know where that project is, because what happens if the borrower gets in trouble, especially if it's a non-performing loan and they're already in trouble, and then you have to foreclose on a property that's half finished. The rentals are half done, right? That could be troublesome, because then now you're going to have to put on your property fix and flipper or new construction hat, if you have those skills, and get that project to completion. Okay, so I would say this is a note investor who has a lot of construction background, remodeling background. These are good investments for you because you know this space. If you don't have that kind of background and don't know a lot about construction and renovation, this might be pretty risky for you. Okay, so take note of that. If it's a performing interest-only rehab loan and the borrower has shown no signs that they're getting behind on their project, then that might be okay. But those non-performing loans where you don't really know where the project's at, you could drive by and maybe, you could sort of see from the outside where the project's at, but maybe in the inside, there's a lot of expense that needs to go into finishing that project. Okay, so you may also have to have extra capital reserves if you're buying a note like this, just in case you have to foreclose on that borrower and finish the project, or find a new hard money loan, your own interest only loan, to finish the project if you have to foreclose. Okay, so those are my thoughts on interest only loans as a note investor. As a real estate investor, these are perfect for you if you are a house flipper, doing remodels on a property, fix and flips, that kind of thing. I've used these types of loans lots when I've done wholesale and fix and flip deals. You are paying quite a bit of interest on that money, but it's money that you can get that you may not have. And the whole idea is to be able to turn over a completed renovation and sell the property at a lot higher, pay off your lender, and also make a profit. Okay, so there's lots of flexibility there if you're kind of a short-term real estate investor doing these short-term types deals. There's lots of different hard money lenders out there and private money. If you know people that are looking for a high return on their money that want to lend their funds on your project, you know, maybe earning double-digit returns as a lender, that option's there as well for you. So that's interest-only loans. You're only paying the interest each month. You're not making any pay down of the principal balance, and typically they're short-term. So I hope you found that useful. I'm Cal Ewing. Take care.